Hi everyone, welcome to our final video related to risk aversion and chapter 27. Remember from our last video, we talked about the notion that people are risk averse, and one way they can reduce the risk or uncertainty that they have in their everyday life is to purchase insurance. The idea there is if you're facing a risk, you can pay an insurance company a fee, and if that risk happens, that you suffer some sort of financial loss, the insurance company will turn around and compensate the person who is damaged by your behavior. So if you are worried about your driving and getting in an accident and having to pay for that, you can pay an insurance company so that if you do get in that accident, the insurance company will pay the person you injured and you won't suffer any financial loss. We know, however, that when people get insurance, it causes them to behave in a different way, a certain way. And so that's what this little video is about. Again, finishing up chapter 27, and we're talking about how insurance makes people behave differently. There are basically two ways that happens. One relates to this thing called adverse selection, and the other relates to a concept called moral hazard. Now, I'm not going to define those right here. We'll get to that in a second, but those are the two things that we're going to be looking at. Both of these things, adverse selection and moral hazard, come from this concept called asymmetric information. They are caused by the fact that we have this asymmetric information problem. Now, asymmetric is a fancy word, it's a lot of syllables. Basically, it means unequal. And in economics, a situation where asymmetric information is present relates to the situation where one person has more information about their relationship or their own uh, behavior or their own characteristics than the other. In plain English, it means I know something you don't know. Now, that happens a lot in everyday life. For example, it happens in medical care. A doctor knows more about medical services, available treatments for you, and maybe even your own health than you do. That's asymmetric information. Right? She knows more than you do about your medical situation. In insurance, I know more about my behavior as a driver than my insurance company does. I know if I'm a good driver, if I'm a risky driver, if I speed, if I text while I'm driving. And so I have more information about my behavior than the insurance company, and that's a problem. For buying and selling transactions, the purchase and sale of of goods and services, consider what goes on when you're buying a used car. The seller of the used car knows more about that car's condition than the buyer does. She knows whether it's driven carefully or or it's driven only um, on Sundays or in good weather, or it's driven in the snow, or the owner beats on it, right? So the fact that the seller knows more than the buyer creates an asymmetric information problem. In all three of these cases, because everyone knows that one party knows more than the other, we all approach these kinds of transactions in a certain way with a little bit of sort of hesitancy. All right, so asymmetric information is all around us, and it creates this notion of adverse selection, for example. So what is that? It means that adverse selection is present when a high-risk person benefits more from insurance, and so that person is more likely to purchase it. Think about this, you guys. If you're healthy like you might say, well, why would I pay a fee to an insurance company who will pay for my loss if I'm not going to I'm not going to have a loss, if I'm not going to get sick? That's a waste of money. I may not buy insurance. But on the other hand, if something about you convinces you that you will get sick, let's say that you already are, or your family history suggests that you'll get sick in the future, you might have a history of heart disease in your family or something, you might say to yourself, I better get insurance now so that when I do get sick, and I think I will, the insurance company will come in and pay for my loss. They'll pay for my hospital care or whatever, right? So we've got, on the other hand, healthy people will avoid insurance. They don't want to waste their money, but sick people will buy insurance because they know they're going to need it in the future. Right? That's what happens. Sick people are more likely to buy insurance than healthy people. Now, that's fine for the insured person as far as it goes, but what happens if you're the insurance company? You have suddenly a bunch of clients, all of who are sick or will be sick very shortly, and nobody who is healthy that you can collect premiums from. So an insurance company has all these sick people. Suppose they all got diabetes at once and required expensive medical care. What happens to the insurance company? They'll end up paying lots of claims with no sort of free premiums from the healthy people to back them up. That creates a big problem in insurance markets, right? It creates what we call a death spiral of adverse selection. All right, so here we start. Individuals know their risks, but insurance companies don't. That's the asymmetric information problem. That creates adverse selection. Individuals at high risk purchase more insurance. Individuals at low risk purchase less insurance. That means overall, the people who are insured create a higher risk for the insurance company. And because insurance companies will have to pay money for those risky people, they're not Santa Claus. They are a for-profit business. They're going to raise the prices of insurance to pay for those sick people. So now all of a sudden insurance premiums go up, and it makes it even more expensive and less attractive for healthy people to buy insurance. So we have more healthy people drop out, right? And what remains yet again are high-risk people who end up paying higher premiums. And this circle continues until it creates what we call a death spiral, and insurance companies eventually go out of business. This is one of the problems that Obamacare was trying to solve when they drafted the legislation. In fact, Obamacare was drafted by an economics professor from MIT, John Gruber, who knew all about adverse selection. Right, so adverse selection creates problems for insurance companies. The other problem that is created is relates to moral hazard, right? Moral hazard is a little bit different. It says that people with insurance have less incentive to avoid risky behavior, right? If you have insurance and you know that if you create a loss, if you drive badly, right, the insurance company will pay if you crash your car, then you're free to, more likely drive like a crazy person. You'll speed or text, right? In health insurance context, if you have health insurance, you may, and you don't have to worry about paying for doctor bills or hospitalization, you may more likely behave unhealthily, eat 12 cheeseburgers a day, right? That's moral hazard because you no longer have an incentive to live well because you have no worry about a financial loss if you don't, right? There's a good example, right? Speeding ticket insurance, we'll pay all of your fines. What is that going to do to your behavior? You'll say, well, if I get a ticket, I don't have to pay for it. I might as well drive fast, right? This is moral hazard. That's what it's about, right? So adverse selection, risky people will buy insurance, healthy people won't. Moral hazard, risky people who buy insurance will engage in risky behavior, and that is not something insurance companies want to deal with either. That's it for chapter 27. We'll see you guys online.